If you're on Medicare and you're collecting Social Security, I need you to look at your most recent benefit statement before you watch the rest of this video, because there is a very good chance the amount being deducted from your check for Medicare is higher than it was last year. And there is an even better chance that nobody from Medicare or Social Security ever called you to explain why. Millions of seniors are quietly losing hundreds of dollars a year to premium increases, surcharges, and hidden adjustments that most people don't even know exist. By the end of this video, you're going to know exactly what Medicare is taking from your check in 2026, the 4 hidden charges that catch seniors off guard, the 1 mistake that can raise your premium by hundreds of dollars a month, and the 3 steps you can take this week to make sure you're not paying $1 more than you have to. Let me start with the basics, because this is where most of the confusion begins. When you turn 65 and enroll in Medicare, you are automatically signed up for 2 parts. Part A covers hospital stays, and for most seniors it is free because you paid into it through payroll taxes during your working years. Part B covers doctor visits, outpatient care, lab work, and most of the medical services you actually use day to day. And Part B is not free. There is a monthly premium, and for the vast majority of seniors, that premium is deducted directly from your Social Security check before the money ever reaches your bank account. In 2026, the standard Medicare Part B premium is $185 per month. That is the baseline. That is what most seniors pay. But here is the part nobody explains clearly. The standard premium is just the starting point. There are at least 4 other charges layered on top of it that can quietly raise your monthly cost by $50, $100, even $400 or more. And most seniors have no idea any of these charges apply to them until they see a smaller deposit in their account. Let me walk you through the 4 hidden charges one by one. The first hidden charge is something called IRMAA. That stands for Income-Related Monthly Adjustment Amount, and it is the single biggest reason seniors end up paying more for Medicare than they expected. Here is how it works. If your income 2 years ago was above a certain threshold, Medicare adds a surcharge to your Part B and Part D premiums. In 2026, that threshold starts at $106,000 for a single filer and $212,000 for a married couple filing jointly. If you cross that line, your premium goes up, and the higher your income was, the higher the surcharge. At the top of the scale, IRMAA can add more than $400 per month to your Medicare premium. That is almost $5,000 a year extra, just because of where your income landed 2 years ago. Now here is the part that catches people off guard. IRMAA is based on your tax return from 2 years prior. So your 2026 premium is based on your 2024 income. If you had a one-time event in 2024, you sold a house, you cashed out an old retirement account, you took a big required minimum distribution, you received an inheritance, or you took a lump sum from a pension, that one-time spike can push you into a higher IRMAA bracket for 2026, even though your actual income this year is much lower. Most seniors don't know they can appeal this. We'll get to how in a few minutes. The second hidden charge is the Part D late enrollment penalty. Part D is the prescription drug portion of Medicare. If you didn't sign up for Part D when you first became eligible, and you went without what's called creditable drug coverage for more than 63 days, Medicare adds a penalty to your monthly premium for the rest of your life. The penalty is 1% of the national base premium for every month you went without coverage. That doesn't sound like much until you do the math. A senior who delayed Part D for 5 years is paying around 60% extra on their drug premium every month, forever. And it never goes away. It is permanent. The third hidden charge is the Part B late enrollment penalty. Same idea, different program. If you didn't sign up for Part B when you were first eligible, usually at age 65 unless you had qualifying coverage from an employer, Medicare adds 10% to your premium for every full 12 months you went without it. So if you waited 3 years, your premium is 30% higher every single month for the rest of your life. This catches a lot of people who retired early, lived off savings, and figured they would deal with Medicare later. By the time they signed up, the penalty was locked in. The fourth hidden charge is the most invisible of all, and it shows up in a different way. It's the cost of being enrolled in the wrong Medicare Advantage plan, or the wrong Part D plan for your situation. Medicare Advantage plans, which are the private alternative to traditional Medicare, change their networks, drug formularies, and out-of-pocket costs every single year. The plan that was perfect for you in 2024 may have dropped your doctor in 2025 and raised your copays in 2026. Most seniors stay in the same plan year after year out of habit. The average senior who switches plans during open enrollment to a better fit option saves several $100s a year, sometimes more than $1,000. Staying put is not free. It just hides the cost. Now let me tell you about the one mistake that can raise your Medicare premium by hundreds of dollars a month, because this one is preventable and almost nobody talks about it. The mistake is failing to plan around IRMAA before you make a major financial move. Selling the family home in retirement, doing a large Roth conversion, taking a lump sum withdrawal from a 401k, or cashing in a large investment can all push your income into a higher IRMAA bracket for the year. And because IRMAA looks at your income from 2 years prior, you don't feel the pain until 2 years later. By then, it's too late to undo the transaction. If you are planning any major financial move in retirement, talk to a tax professional first about how it will affect your Medicare premium 2 years down the road. A little planning here can save you thousands of dollars. But here's the good news. If you've already been hit with an IRMAA surcharge because of a one-time income spike, you may be able to appeal it. This is the part of Medicare almost nobody knows about, and it has saved seniors thousands of dollars when they use it correctly. You can appeal IRMAA if you've experienced what Medicare calls a life-changing event. The qualifying events include marriage, divorce, the death of a spouse, retirement or reduced work hours, the loss of a pension, the loss of income-producing property due to disaster, or the receipt of a settlement payment from a former employer. If any of these apply to you and your current income is significantly lower than the income on the tax return Medicare is using, you can file Form SSA 44 with your local Social Security office. If approved, your IRMAA surcharge is reduced or eliminated, and in many cases, retroactively refunded. Now let me give you the 3 steps to take this week to make sure you're not paying $1 more than you have to. The first step is to check your most recent Social Security benefit statement and find the exact amount being deducted for Medicare. You can do this by logging into your account at ssa.gov or by checking the deposit summary from your most recent check. Compare it to the standard Part B premium of $185. If you're paying significantly more than that, IRMAA is almost certainly the reason. Knowing the exact number is the first step to fixing it. The second step is to review your IRMAA situation. Pull your tax return from 2024 and check your modified adjusted gross income. If you cross the $106,000 single or $212,000 married threshold, you are paying an IRMAA surcharge in 2026. If a life-changing event has happened since then, you retired, you lost a spouse, you stopped working, you sold income property, you may qualify to appeal. Download Form SSA 44 from the Social Security website. Fill it out and either mail it in or bring it to your local Social Security office. The form is 2 pages. The savings can be thousands of dollars per year. The third step is to use Medicare's Plan Finder tool every fall during open enrollment, which runs from October 15 through December 7. Go to Medicare.gov, click on Find Health and Drug Plans, enter your prescriptions and your preferred pharmacies, and let the tool show you which Part D and Medicare Advantage plans actually cost you the least, based on your real medications and your real doctors. The tool is free. Most seniors have never used it. The ones who do save money almost every single year, Even if you love your current plan, run the comparison. 5 minutes once a year can save you hundreds of dollars. Let me close with this. Medicare is one of the most important programs this country has ever built. And for most seniors, most of the time it works. It pays for the doctor visits, the hospital stays, and the prescriptions that would otherwise wipe out a retirement savings account in months. But the system has gotten complicated. The premiums have layers. The penalties are permanent. The surcharges are tied to income from years ago. And the people who pay the most are not the people with the most money. They are the people who didn't know the rules. If this video helped you, please share it with another senior who needs to hear it. Your spouse, your sibling, your neighbor, the person who drives you to your appointments. Because the difference between paying the standard Medicare premium and paying hundreds of dollars more comes down to information. And information only helps when it gets passed along. And if you want more videos like this one, breaking down the rules that actually affect seniors in plain English, hit subscribe. I post new videos every few days covering Social Security, Medicare, banking, taxes, and the parts of retirement that nobody bothers to explain to you. Take care of yourself, take care of your money, and I'll see you in the next one.